By now we have understood the importance of market structures and moving averages. Based on it, we identify the trend filter. Now, what if the market structure fails? That's our entry point, right? So if the market structure fails, what next? This is what we are going to understand now. A market structure fails. It's a very important message from the market. If a trend is bearish and if we get a market structure low, that means the markets are sideways because bullish pattern but bearish trend. So markets are sideways. In this case, failure of market structure low will give us a trending move. So the shift from non-trending phase to trending phase is decided by either two cases. One, if you find a market structure in the direction of the trend, you trade trending markets. But if the markets are non-directional, that means you have a market structure low, below moving average, then the failure of market structure low becomes a bearish pattern. So failure of market structure low will trigger a bearishness. Similarly, if markets are bullish and you get a market structure high, that means the trend is sideways, right? Market structure high in a bullish trend above moving average is suggesting a sideways market. But the moment failure of market structure high, which is a bearish pattern, triggers bullish trend. So now failure of market structure high, from there we are going to calculate 200 points in the money and we are going to select that strike and we are going to short that strike because now the markets have become trending. So failure of a opposite market structure in the direction of the trend triggers a trending move. So when we come into a trending move, we again calculate 200 points in the money, we short that option so that we get the best possible entry price. So this is how you select the strike price when the markets are trending.